And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And good morning and welcome to the show. Of course, it is a Monday as we get into the first week of February, and already the month of January behind us. Still a bit chilly outside, but already 1 month down. Week after next will be Christmas. At least it'll seem it goes that way. So my wife, if my wife hears that, she'll be getting Christmas trees out already. So yeah, don't say anything, okay? So anyway, but yeah, time flies, and of course, as we start a new month, that means that we've got a few new things to talk about. As we start the month, we're going to get an employment report on Friday. We're going to start seeing, ISM, PPI, CPI numbers over the course of the next few weeks. We're right in the heart of earnings season this week. We get more of the kind of the mega cap earnings this week. Apple reports this week. So, we still have that whole earnings season. So far, about 45% of S&P 500 companies have reported, mostly good reports. Stocks that have missed earnings or missed revenue or missed their outlook was weak have been pretty heavily punished. But, companies that have, beat well and given good guidance have done well. Overall, we're having a fairly good earnings season so far. And again, that should continue this week. Again, lots of reports this week. That'll certainly be kind of the focus of the market this week. But after this week, we'll have about 80% of all the companies will have reported. The buyback window is going to open back up. So we should start getting some support coming back into the markets as those buybacks kind of resume. So we'll see that now. 40% of companies are now out of their windows. So we're starting to see that now, but that will increase over the course of the next really kind of 2 weeks. Now, we won't get NVIDIA until the very end of this month. So again, while that's going to be kind of moving the whole narrative of the AI market, that one's still pending out there, and we'll get to that when we get there. One thing to talk about is that January had a very positive first 5 days of the year. January turned out to be a positive month. That bodes well for the entire year. It is about an 87% win rate when the first 5 days of January and the entire month of January tend to be positive. That tends to bode well for the rest of the year. Again, 87% of the time. Now, all that means is if we're up 0.1% by the end of the year, that was a win, right? So it doesn't mean 20% return years in the wind here because you've had a positive month of January, but it does suggest that the entire month, the entire year tends to be better performing when you have a good start to the new year, and at least that's been the case so far. So we can be a little bit optimistic on that side. However, before we get there, we've got to get through February. The month of February tends to be weaker. It tends to be one of the weaker trading months of the year. It's about a 50-50 win rate overall in terms of its wins and losses. But it does tend to have also just weaker returns in general. A few reasons for that. There was a lot of positioning back in January by professional money managers to kind of get positioned for the new year. Now we're going to start kind of dealing with, what their real expectations are for the year. And again, with earnings now season kind of getting behind us, they've got a better idea about how to position for this year. So again, while everything looks fine, that month of February tends to be weaker now because with January behind us, portfolio managers can start kind of adjusting for what their expectations are for this year. And, we'll kind of see how that works along. Outside of that, though, all the economic data continues to do fine. We saw the Chicago PMI report on Friday, big uptick there. We're starting to see kind of regional employment surveys starting to improve here a bit. So that whole reflation narrative that we've been talking about continues to kind of mature here. The economic growth is good. It's not fantastic, but it's good. It's good enough for the win, right? And again, as we kind of look at this, kind of in the narrative of earnings growth and economic stability, those type of things, the backdrop for the market is okay. It's not fantastic. It's not booming, but it's okay, and it's enough to generate kind of positive returns here in the near future. Okay. As we just kind of look forward, everything's fine. Let's talk about what you need to know before the bell this morning. Lots of action on Friday, of course. Let's start with the S&P 500. S&P 500 came down on Friday. set right on the, kind of broke below the 20-day moving average on Friday, but rallied back up, closed above the 20-day moving average on Friday. So technically the market is still fine. We're in this kind of this volatile uptrend, right? We're just kind of stair-stepping a little bit higher here. Every time we get close to or make a new high, the market struggles with that resistance level. That's just been the case here for some time. And as we just kind of continue to grind this higher, markets are not exceedingly overbought. Momentum is not running off the rails here. It's at fairly moderate levels. It's continuing to suggest that markets can just kind of grind itself here. No real threat here of a big drop off, at least at the moment. Markets are just rotating internally. We see it move from mega cap names one day or 1 week into value names the next week. Value, and as we talked about early this year, value stocks were kind of a rotation that we made in portfolios because we kind of expected a little bit of this volatile cycle. Staple stocks, those stocks have been doing very well. In fact, they're now getting pretty overbought, and technology, as an example, is getting pretty oversold. So we may see some of that rotation out of that value trade now back into the growth trade, particularly if a lot of this economic data continues to report better. But I know what you really want to talk about, which was the drop in silver and gold on Friday. This was something we've talked about here numerous times on the show. We recommended numerous times: manage risk, take profits, rebalance. What happened on Friday is not surprising, unexpected. This happens repeatedly in commodity stocks in particular, because they're driven by the futures market. All this run up in the market going into this is, as we explained previously, is not about a debasement trade. It's not about all the narratives that are used to rationalize rising prices. Those are nonsense. They're not based on any real factual data that we've gone through numerous times. It's just the rationalization for speculators to be long futures in the futures markets. And futures markets are heavily leveraged. What's important to understand is how they work. When you start to have rising prices, this is all driven by futures. So when you buy a call option future, as an example, on a commodity, somebody has to be short this. So there's an arbitrage that goes on in this market. So the more that markets go up, the more it creates this arbitrage pressure, pushing prices higher until that eventually breaks. Why does it break? Could be just psychological, could be a lot of things. Somebody holds up their hand and says, hey, I'm out. But once you start getting that selling pressure to reverse, you start getting leverage and margin calls. As that occurs, that forces selling immediately in the markets. And this is what we saw on Friday, was an unwinding of leverage. This was like Oprah Winfrey on Friday. Everybody gets a margin call. You get a margin call, you get a margin call, everybody gets a margin call. You get this big unwind. Now, we wrote an article on January the 5th saying when this occurs, there's going to be all this stuff out there. It's like, oh, it's manipulation. This happened, that happened. No, this is just the process of unwinding of leverage in markets. This happens repeatedly throughout history. It just happens to be bigger in commodity-based markets because of the volatility and the leverage that's in those markets. On Friday, not surprisingly, JP Morgan, everybody was like, see, JP Morgan closed out they were manipulating the bottom. JP Morgan closed out their shorts right at the lows, which they did on Friday, which was this 50-day moving average. Not surprising. JP Morgan had the other side of that arbitrage trade, and when we got down to this 50-day moving average, they covered all those shorts, started buying. And they started pushing the markets back up here as they started closing out their short positions. This is just the way the market works. The leverage call, the margin calls were getting covered. They started unwinding their short positions or arbitrages against those contracts. So again, this is just completely normal market behavior. This happens in commodity markets all the time. They are the most volatile of all different asset classes, which is why you want to be careful when you're investing in commodities because of these big potential unwinds. We're seeing this happen today, as a good example, in oil. We're seeing a big decline in oil this morning. Happens in commodity markets. Over the weekend, and is happening today, the commodities market, the CME and the COMEX, have raised margin requirements by 33 to 36% on various metals: palladium, platinum, copper, and silver, gold and silver. All those margin requirements are going up by over 30%, which means now traders have to hold more collateral against their contracts in the open markets. And again, large commercial speculators are the ones that are really driving this market more than anything else. Retail investors are trying to trade that trade, but it's the large commercial speculators that control that trade. So this is, again, just something to be paying attention to. There's risk in that market. That's why we continue to talk about taking risk, rebalancing portfolios. We're still long silver and gold, but we reduced those going into this last week, the week before. Why? Just because they had gotten very overweighted in portfolios. It was time to take some profits, rebalance risk. That's just good portfolio management, but it protects you against these big declines in commodity markets. Now, likely we are not done with that decline just yet. There's a lot of long positions that got trapped on Friday. Not surprising, we might see a bit of a bounce today, which we're seeing in the early futures market. I think we're up about 8% on silver this morning. That is likely going to give you a decent bounce, maybe up to around $93 on silver, but there's a lot of trap longs that will eventually probably liquidate. We get another downturn, and that's where you start to potentially find your bottom in silver for a tradable opportunity in the future. Just be careful with this bounce. You may get 1, 2, 3, 4 days. There's still a lot of people wanting to be, that narrative is still very strong. So we're going to see a lot of people jump in here, go, oh, look, I bought it here, and now it's a lot cheaper. I'm going to buy it here. Be careful with that. There's going to be a lot of people that kind of are entrapped in this position. They got home on Friday after work, and they're like, oh my gosh, what just happened? There's a lot of traders on the wrong side of this position as well. So look for a potential reflexive rally here. Another test of potentially lows, maybe even set new lows before you eventually find your bottom here. So just be careful with your trading positions. Understand we could see a bit of volatility over the course of the next couple of weeks as we kind of work through the process. Okay, anyway, that's what you need to know before the bell this morning. When we come back, we'll talk about the extinction of bears. Don't go away.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
And now, another page from the Real Investment Advisor's Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
All right, welcome back to the show this morning. And let me see if I can get... my computer's being a little bit glitchy this morning. Give me just 1 second. Try to get... Brett didn't bring up my YouTube this morning. It's all right. It doesn't work over there. We've got one of our computers is down this morning, so I'm just running a little bit one hand behind my back at the moment, which is not uncommon. For some reason in our studio, there's always something breaking down. There's but yes, we have a new computer coming. It's on its way. So I wrote an article over the weekend talking about something that I think is worth paying attention to. And this kind of goes along with what we were just talking about with silver, is that, when there's a movement in the markets, up or down, both up and down, people tend to start rationalizing why this is occurring. And then they extrapolate this to mean that it's just going to be this way forever, right? This is the whole problem with the debasement trade. It's the whole problem with everything else, is that people start to extrapolate this to justify their positioning. And they go, this is going to happen. The end of the world is coming and the dollar is going to go to zero, whatever it is. And this is why I'm owning silver and gold. Understand that these are just markets, that narratives are fine, but most of them are not based on economic or financial realities. It's just a narrative. It's a fear. It's an emotion to explain or to justify taking on excess risk in a market. And that's fine as long as things are working for you, right? Silver's going up, gold's going up, everybody's making money, everybody's happy, stocks are going up, everybody's happy. Right now, as a good example, I was posting this morning just to give you an example of kind of what we're talking about. I just posted this chart this morning on the percentage. So this is a chart of the percentage of markets that are at all new highs globally. Right now, we have global new highs. 85% of all markets are at all-time highs. That hasn't happened that often previously, but when it does, there's been some periods where that has been kind of the peak of the markets because everybody's bullish, and there's a reason for that. Right? Talk about the stock market. Stock market's near all-time highs. Just hit all-time highs just a week ago. Reason? Reflation trade. Economy's going to grow. We're not going to have any inflation. Everything's going to be fantastic. It's the perfect Goldilocks environment where you have economic growth, no inflation, and the Fed can cut rates. Now, if that all works out, that's fantastic. But that's really just a justification. That's why am I willing to overpay for stocks when I really shouldn't? Because I have reflation. I can justify that because earnings are going to be so good this year because of this reflationary narrative. Maybe that's the case, and I'm not saying that's not going to be the case. We've been writing over the last couple of weeks in particular talking about this reflation narrative. In fact, that was kind of Friday's article a bit, is talking about this reflation narrative and just looking at the pros and the cons, why it could happen, why it could not happen. This is the narrative. The facts are the fundamentals, the underlying earnings growth, those type of things, which are okay right now. So there's no reason to be overly bearish on the markets because the underlying fundamental supports of these markets are doing fine. But this is why we talk a lot here on the show about be careful with narratives, because one day you wake up and everything kind of goes wrong all at once. and that's the side of the trade that you don't want to be on. This is why, again, talking about risk management, talking about the things that are important to navigate cycles will help you survive these kind of market events as they occur. So kind of the premise of the article from the newsletter this weekend is that bears are extinct. Bears are now on the endangered species list. There is nobody bearish on pretty much anything. Here's a chart of the short interest on the S&P 500 and the NASDAQ. The short interest on the NASDAQ is at 6%. It's never been lower. You're only at about 10% short interest on S&P 500. That's also a very low level. So there's basically nobody bearish on the markets. Everybody's long. And Sam Stovall, who was the head of S&P research for a very long time, he works for S&P Global. He once said that when everybody's bullish, there's nobody left to buy. Everybody's long. And this is one of the things that I've explained to you before about how markets work, and this is why it's so important to understand market dynamics, particularly when you're managing your own money, is that there's a relationship between buyers and sellers in the markets. Whenever a transaction occurs, just like on Friday with silver, in the midst of that decline in silver, there were buyers all the way down. Because every time somebody sold, somebody had to buy it. There has to be a buyer for every seller. The question is always at what price. And there's a kind of a pyramid relationship in the markets between how buyers and sellers interact. As price is rising, sellers become more scarce. They're like, why am I going to sell my silver, my gold, my stocks, whatever it is? Why am I going to sell that when it's going up? I don't want to be out of it because I don't want to miss upside, right? That's just our emotional nature of greed. However, there's a price where we'll all sell something. both up or down. So as prices are rising, buyers have to keep stepping in and going, I'm going to pay you more for this asset price because I want it. And the seller says, okay, great, I'll sell it to you, but it's going to cost you this much. And this is why you see things kind of gap up sometimes. And we saw this in precious metals just recently, where silver would be up 5 or 6 or 10% in a day. And that was because sellers were going, yeah, I'll sell it to you, but it's going to be 10% higher. And then that's how you get there. That's why you have these big gaps that open up in the markets. But as that occurs, you have fewer and fewer sellers that are doing that. More and more people are buying. That's the sellers that are willing to sell are demanding higher prices. So you've got this rush of buyers in to chase prices higher, but you have fewer sellers willing to sell, which is spiking these prices higher. So you get these big moves in markets, stocks, commodities, etc. This is what happens. This is how you get these big price moves. However, the inverse also occurs. At some point, something happens that causes a reversal in that price. Now, all of a sudden, everybody that was unwilling to sell previously wants to sell all at once, and buyers are going, hey, I'll buy from you, but here's going to be the price lower. So as the prices fall, you get more and more sellers come into the markets. Buyers are becoming more scarce, so it works in reverse, and it works against you. And this is how you have these very big declines that occur. You know, you get a 5% down day in the markets like we saw in 2020. You get a 30% down day in silver like we saw on Friday. That's how that occurs. It's just that supply-demand imbalance working itself in the markets. And of course, you throw on leverage and margin calls and everything else, and things can get bad pretty quickly. But this is also a lesson in here about portfolio management and portfolio risk management. A lot of the things that people were sending me and emailing me about, you know, you're crazy being in stocks, you need to be in silver and gold because the market's going to crash. Yes, someday the market will have a 30 to 50% correction. That is absolutely going to happen. But the difference between commodities and stocks is they don't happen in a day. A 30 to 50% crash in the stock market will take 6 to 8 months. It's going to give you plenty of opportunities to rebalance your risk and get out of the market and do whatever you need to do. The problem with commodities is commodities crash regularly, and they will do it in a day. And this is why risk management is so very important to understand. This is, as we spoke about previously, we begged you, take profits, rebalance risk. This is why. This was always going to happen. It was just a function of time till it happened. And sometimes it can take a very long time to get there, but these things happen. And this will be over. And there'll be another opportunity on upside to participate. But if you didn't take positioning off the table, you don't have capital to buy, quote unquote, buy the dip. 30% dips are a bit hard to deal with, but it is a dip. But this is also what happens in the entire environment of any market or any asset when you have this big imbalance. And when you have nobody bearish on an asset or a market or an environment, the risk builds that you're eventually going to have this reversal. And that's what's happening in the markets now. And I think it's a risk that we certainly need to be paying attention to. Now, it's important to understand, I'm not saying that the stock market is going to crash by 30% tomorrow. I am not saying that at all. But I'm saying that I think we need to be aware of the risk that everybody is in the risk pool. There is literally nobody on the beach right now. Nobody wants to be short. Nobody wants to be out of the markets. Nobody wants to be on the sidelines. Whatever it is, everybody wants to be invested. And this is particularly true with retail investors, which are the least equipped to deal with markets in this environment. It's been easy to make money. And I get emails from people every day saying, I'm a DIY investor. I manage my own money. It's been a super easy market to manage money in for the last 15 years. You don't really need to do a whole lot. It's been fantastic. But we've been in a nice big secular bull market where volatility drawdowns have been fairly reasonable. 2020 was well within the bullish uptrend. We never broke the bullish uptrend of the markets. Even in March 2020, we have maintained ourselves in this kind of consistent bullish uptrend within the markets. This is kind of as I published an article this morning as an example. Let me see if I can find it here real quick, that has a very important chart in it. And this was in today's article that I just posted out this morning. Is talking about market cycles this year. So we've got the presidential market. So we're in the second year of a presidential cycle, which tends to be a little bit weaker than the other years of the markets. We're also in the 6th year of a decennial cycle, which tends to be one of the weakest performance years of the markets. And doesn't mean negative, but it's about a 53% win rate in the 6 years of the 6th year of the decennial cycle. So it's about a 50-50 coin flip, and the average return tends to be about a negative 1.29%. That's on average. So the drawdowns tend to be bigger in the 6th year of the decennial cycle. But the important part is this chart. And Brent, you're going to have to kind of work some magic potentially to get this all on the screen for everybody. But this is a monthly chart of the S&P 500 going back. Whoops. Sorry, it jumped on me. I forgot to pause the transition. This is a monthly chart of the S&P going back to 1900. And the top chart is just the price of the market and 2 and 3 standard deviations from long-term moving averages. And of course, we're very deviated from long-term moving averages. Valuations, which is the second piece down, is near all-time highs. So, the valuation story is certainly not a big issue here. Or I shouldn't say a big issue. It's not news, right? Everybody's very aware right now that we have an overvalued market. The bottom is the relative strength of the market, which is interesting because the relative strength of the market on a monthly basis has been declining. We have this negative divergence between relative strength and the markets going higher, which typically suggests that there's potential risk for the markets going forward. Again, there's just this, participation issue, the relative strength of the markets, et cetera. So the markets are rising, but that relative strength is declining, and that's typically a more worrisome sign and something worth paying attention to. Again, this is the monthly. I'm sorry, I said monthly. This is quarterly data. So this is very, very slow to move. This is not a market timing exercise. But what's important to understand here is that on a Bollinger Band basis, this data. Brent, can you zoom into that little kind of table box in the upper left-hand corner? Upper left? Yeah, where you see the yellow highlights. I just want to zoom in on this real quick because these are some readings for the markets going back 125 years. And right now, the deviation from the Bollinger Band is 12.82%. So now this is a deviation from long-term moving averages that is 12.82. That is the highest deviation on record on a historical basis. That is where we are right now. So the top is the maximum historical readings. The bottom is the current readings. So in other words, we are at a level, that deviation from the long-term quarterly moving average of 12.82 is the highest level on record. That's now. That's not the historical peak, and we're somewhere in between. Bollinger Bands are at their biggest deviation on record, going back historically. The CAPE ratio is not at its record. We had a 43.83 CAPE back in 2000. We're at 39.37. RSI, its peak was 97.94. See, this is what I'm talking about here. Relative strength right now is 66.75. It's not, 70 is where you're starting to get really overbought. We're not grossly overbought on a relative strength basis. The problem is that relative strength is declining as the market's going up. That negative deviation is what I'm talking about. But again, everybody's bullish, and that's something at least worth paying attention to, because for the last 10, 12, 15 years, it's been a gravy train to make money. You just buy every dip, markets go up. But that's what's led to these excess valuations that we currently have in the markets, and why we need to be paying attention to the amount of risk we're taking in portfolios, because we start kind of falling into this false narrative that I can't lose. I just buy the dips. Everything is fine. Markets just go up. So I can take on this excessive level of risk. And if you're young, go for it. Right? I mean, just if you're in your 20s or your 30s right now, do this. Take 70% of your money and just stick it in an S&P 500 index and just contribute to that every month. Your other 30% of the money, do whatever you want with. Go chase silver, go chase, Bitcoin, whatever it is you want to buy, go buy meme stocks, speculate to your heart's content, right? If you make a bunch of money, fantastic. If you lose it, it's going to hurt. But that 70% that you've got just kind of investing, growing in the S&P, it's going to be there, and just leave it alone. You just contribute to it every month and leave it alone, and in 30 or 40 years, you're going to be fantastic, right? And even if you blow up the other 30% of your portfolio, you'll still be okay. If you're 55 or 60, you don't have that kind of time. So navigating these markets are going to be a lot more important for making sure that you ensure your retirement ahead of time. And this is, and again, for most of the time that we're talking here on the show, I'm talking to you. I'm talking to you older guys and gals like me who don't have that long to retirement. Now, there was some good news out this morning. The life expectancy rate for both men and women are now the highest on record. And the average person should live to about 79 and a half, both male and female. That's the average. Women live longer because men just want to get the hell out of here. So, you can only deal with it for so long. But women, you're going to live to well into your 80s. Men, the 70s are still kind of a tough mark for a lot of men. But on average, we're all living longer. And that's good news, because if I'm retiring at 55, I've got, 25 years ahead of me to, make my money still grow, participate in the markets. But I also need it to be there to live on as I get older and do retire and those type of things. We just don't have that opportunity to take a big loss in portfolios and then try to hopefully recover it over time. Now, that's been an easy process over the last 15 years. Dips have been very short-lived. Recoveries back to new highs have been very quick. And so we've kind of been lulled into this false sense of security that I don't need to worry about risk management. I just buy stuff and it goes up and it's easy. And again, for me, my job, it's been so easy for the last 15 years. I mean, it just has, out of all the years that I've managed money in various forms, the last 10, 12 years have been dramatically easy. Just invest in stocks, they go up, invest in whatever you want, it goes up. That's been an easy job. That will end. When it ends, who knows? But we're going to get back into a period, much like we saw in 2000 through 2013, like we saw in the 60s and the 70s, like we saw post the crash in 1929, the 1930s and 40s. We're going to get into this period where markets are still going to perform, but they're going to be a lot more volatile and returns are going to be lower. But that may not occur until 2030s. The rest of this decade may be just fine, because again, there's a lot of psychology and emotion. There's lots of liquidity. We've got a whole generation of young people coming up that are speculating and gambling in markets, trading on Robinhood, et cetera. So that liquidity push flows into markets. Again, we can't ignore the impact of passive investing, where I'm not bullish or bearish. I just stick into an index and I just go on about my life. But all that impact of monetary flows into markets continues to support markets. And we have a very dramatic change over the last 20 years of this rise of passive investing into the markets. All these ETFs. Again, last year we had 1,000 new ETFs come into the markets. All that requires capital to fund them, investors to come in, give them AMM, because if I launch an ETF and nobody buys it, doesn't impact the markets. But if I launch an ETF and I can raise a couple $100 million in assets,
I can make I as the ETF manager can make money at that. I'm not gonna be the next Bill Gates, but I can make a decent living managing a couple $100 million in an ETF from the fees I collect. But every time one of those ETFs comes to market, brings dollars in, those dollars buy the AUM or buy the ETF, and the ETF has to go out and buy the underlying stocks. And as we note, most of these ETFs are not that different from each other. They may have different little twists on the theme, whatever it is, but a lot of them are all buying the same stocks. We've published before here on the Real Investment blog that looking at how many ETFs own Apple, right? And you start digging into the ETFs that own Apple, and it's not just a growth ETF. It's growth ETFs. It's large cap ETFs. It's large cap value ETFs. We found small cap and mid cap ETFs that own Apple because everybody's chasing the assets that were going higher. And so in order to get AUM, I have to post performance. And if my ETF is in an area that is not posting good performance, I'm not going to attract AUM, right? So it's all a performance chase game, which pushes more and more of these ETFs to buy the same stocks that are all going higher, or to issue out an ETF to raise assets that are chasing a particular theme. But that's just the way the markets work. And this is why last year, as everybody was chasing markets, you saw so many ETFs come to the markets. Everybody was going, hey, there's a demand. Everybody wants this crazy stuff. Let's throw an ETF out there that's 2x leverage this or 2x leverage that. And as we talked about previously, they tried to do 5x leverage because there was demand for it. There were people going, I want more leverage. And somebody said, okay, well, they want more leverage. I can take some options and we can create a 5x. And now, thankfully, the SEC, the SEC had at least enough foresight to go, that's probably not a good idea, and didn't let them do it. But that's demand driving product innovation in markets. So when there's a lot of demand for silver or gold or Bitcoin or you saw this with Bitcoin, right? Everybody wanted to be in Bitcoin. So what happened? ARK, BlackRock, Fidelity, everybody else came out with ETFs so you could buy Bitcoin. It also gave the markets a great way to short Bitcoin because now I can just short the ETF. I don't actually have to short the coin itself. I can just short the ETF. So you also gave the markets an ability to arbitrage those trades, which reduces and this is the problem with things that you wish for in the markets. Oh, I want to be in crypto, but I just don't want to deal with the whole wallet thing and all that. I wish somebody would come out with an ETF. The problem with that is that when you do that, so one of the big benefits of Bitcoin is that in order to buy it, you had to set up a wallet, do all this stuff, and it was a pain in the butt, and a lot of people didn't do it. So there was a lot of scarcity to that market. So this is why you saw this, you could see these big, massive price rises in the markets because it was pretty much an unhedged market. But when you brought ETFs to the market because you wish for it, and when you wish for it enough, and the market will certainly create it for you, you gave Wall Street the way to arbitrage off all your trades and to make money with it. And so what happens is when you wish for these things to come to fruition, it's going to eventually compress the volatility of those markets, leading to lower returns in the future. So these outsized returns that you saw previously are going to start getting compressed in the years ahead to where Bitcoin becomes a normal asset at some point. It moves up 1% in a day or down 1% in a day, but these periods of moving 10 or 20% a day in either direction. So there's a good and a bad to this, right? But eventually, this is what happens to all asset markets as it matures and as there's more people in this and you have more products available for shorting and arbitraging and hedging and all this other stuff, you're going to compress the volatility of the market. So these really outsized gains that you saw early on, kind of in that unrestricted native environment, as it becomes more mature, is going to get compressed. So the return flows in the future are going to be much more normalized. And again, I'm not saying you're not going to make money, but it's going to be much hard. It's going to be much harder for these markets to generate these real outsized returns of, 100% in a year, 200% in a year as a total market. That's going to start getting suppressed back into normal returns. Again, not a bad thing, because one of the things that's limited cryptocurrencies, as an example, from becoming more mainstream in terms of transactions, those type of things. We saw Tesla try it. We saw some other people kind of try temporarily to use Bitcoin as a means of selling a product. It was just too volatile. So once you start compressing that volatility and get more normalized returns, it becomes more stable. It has a much better chance of becoming a more mainstream asset and being able to be used for transactions, those type of things, which is the ultimate dream of this anyway. But that's going to come in time. But again, this is what happens in markets. Wall Street is not stupid in general, and they are going to learn how to hedge, arbitrage, and take advantage of whatever retail investors are doing. This is why Wall Street typically wins. This was again, when going back to silver, this was the interesting headlines on Friday and Saturday in particular. My X feed was just filled with with a whole variety of people's opinions about what happened on Friday, and this was this reason or that reason, and it was manipulation, it was fraud. None of that's true. This was just the market. Margin calls, ultimately. And of course, everybody was saying, oh, look, JP Morgan covered all their shorts right at the low. No, they didn't cover the shorts right at the low. They weren't sitting there going, oh, that's the low, I'm going to buy. They set the low. When they went in and started covering their contracts en masse, and everybody else can see them doing it on Wall Street, they marked the low because they started buying. They said, we're going to set our target at the 50-day moving average because that was a logical support level. And if we get to that level, we're going to start covering our short positions. And they did. And then when they started covering their short positions and they started buying heavily, everybody knows it's them, right? If you're a commodities trader on Wall Street, you know who the buyers are. You just look at the data and it says, oh, look, JP Morgan's in buying, covering their contracts. I'm going to cover mine too. So JP Morgan covered and Goldman covered and everybody started covering, and that's how you got that buying towards the end of the day. But that's what's at the, that wasn't manipulation or fraud. That was just them simply coming into the markets, covering their short positions because they had arbed the long trades. That's just market dynamics. That's the way the market works. But retail investors don't understand that, and so they get trapped into these narratives, and then when things fall apart. And here's the interesting thing. I wrote this article on January the 5th of this year. Let me see if I can find it real quick, and I'll just quote you what I wrote in this article, because this was apparent to what was actually coming in the markets. And we talked about this here on the show several times. There's going to be a chart, and there's actually going to be a quote here as soon as I can find this article. I must have rolled right past it. January the 1st. Oh, here it is. So the title of this article was called Precious Metals Aren't Predicting Economic Collapse. So this was January the 5th. You can go to our website, pull it up. But this is what I wrote. Can you just give me these these kind of three paragraphs that start with the bold pricing? Yes. This is what I wrote on January the 5th. Pricing for all commodities, and particularly precious metals, is ultimately determined in the futures markets. These markets primarily function through the COMEX and the CME, and the long-term physical demand indeed affects prices. However, in the short term, prices are set by futures contracts where buyers and sellers speculate, hedge, and arbitrage for profit. Given that the vast majority of these contracts are cash settled, meaning they don't result in physical delivery, the price is set more by the volume and positioning of financial participants than by immediate physical demand or scarcity. That structure allows large institutions, hedge funds, algorithmic traders to influence price direction through leverage, often independent of underlying physical flows. As a result, even substantial physical shortages or premiums retail markets may not reflect directly in the futures-based spot prices unless accompanied by shifts in futures market positioning. Now, Of those, there's two things that drive that. The first is narrative. The second is price momentum. This is what we actually saw on Friday. Now, you can take this down. So as price rises, you get more demand. Now, I need you to give me one more paragraph shot here, starting with the word lastly. Actually, you can start with the in other words, secure for higher prices. So this is where we are, right? That's what drove the markets. Again, this happens in stocks as well. It just happened to be in metals that was the most obvious. But this is what I said would happen on January 5th. Lastly, another reason prices surge in commodities tend to be temporary is the actual commodity traders themselves. So when commodity prices surge sharply in the COMEX or the CME will raise margin requirements to protect market integrity and reduce systemic risk. That's what they were doing starting in December, and they did it again over the weekend. And again, as we talked about earlier, they hiked those by 33%. So you now have to hold more collateral to be long those contracts. So that increases the risk of margin calls in the future and also helps limit the speculation somewhat in the markets. Those purveyors of perpetual doom will claim it's market manipulation. But in reality, it is a function of managing systemic market risk. Margin is the collateral that traders must post to hold positions, and when prices become volatile, that potential for significant losses increase. Therefore, increasing margin requirements ensures that traders have sufficient capital to cover adverse market movements, thereby reducing the risk of default of delivery. And then we're talking about default on delivery. That's all that happened. It's not market manipulation. It's not fraud. It's market dynamics. It's market functioning. The rest of that is nonsense and narrative. So you need to kind of turn those dudes off, because they're going to hurt you more than they help you in the long run. To just understand how markets work, and you're going to be a lot better off, particularly if you're trying to manage your own money. Anyway, the bottom line is that there are, despite what happened on Friday, everybody's still bullish. Even in the metals markets, everybody's still very bullish. It didn't dent bullish sentiment to a huge degree, which suggests one of two things. Either A, we're going to go rallying right back to new highs in metals, probably dragging the markets along with it, or this is the beginning of a bigger correction that's going to take a little bit of time to work through, and we could see weaker markets overall. And that would kind of align with our discussion over the weekend, is that there's just simply nobody being bearish right now. Everybody's bullish on everything. and correlations are all very high with each other. So that's the potential risk as we look forward out into the rest of this month, and particularly this year. And again, this is why I've been spending a lot of time writing over the last couple of weeks, like today's article on the website, looking at the decennial cycles. Friday's article was talking about market kind of bull bear outlook for 2026, just looking at kind of both sides of the reflation trade. So those are there for you as well. Just trying to put this into some perspective as we look forward this year. Again, we just kind of look back and saying this may be a year of higher volatility. We may see more moves like this, not just in metals, but also in the stock market itself, where we have, a more significant drawdown, 5%, 10% in the equity markets over the course of a month. And then we kind of reset the table a bit, get a rally, back into the end of the year. I still think that's probably a higher probability of bet this year than not. We'll see how that works out. We'll navigate it together here on the show every day and try to work our way through it. And again, and the goal is to survive it as best we can. Anyway, all right, look, enough for today. We'll come back tomorrow, pick up with John Penn. Be sure and give us a thumbs up on the YouTube channel this morning. We'd certainly appreciate it. Helps our algorithms, of course, helps us get our show out there, helps you more as well. If you have any questions or comments, swing by the website and let us know. Send me emails. I answer them every day. Always happy to take your questions. And again, thank you so much for joining the show today, and we'll see you back here tomorrow on the next Real Investment Show.